that maybe it's time to be more bullish on both earnings and EPS targets. Clive McDonnell, head of equity strategy at BNP Paribas, joins in to talk with the strategy that they have put out, which is that it is time to trade alpha. Clive, good afternoon. Good to have you on the show. Just start off by detailing what your expectations are from the Asian basket by way of earnings and why you think there's reason for an EPS upgrade.
Well, overall for Asia ex-Japan, the outlook for 2009, the consensus is minus 11%. But when we look at some of the leading indicators for earnings, specifically the earnings revision index, what we see is that we're starting to see some positive trends coming through, particularly for Taiwan and Indonesia. Specifically, there are a greater number of upgrades out there now relative to downgrades. And we expect that trend will broaden out across the region. So the big bet for 2009 is which markets can actually see positive earnings growth, and that's a big change from where we were just 2 months ago.
Clive, afternoon. What about India? Do you think there will be substantial earnings deceleration this year? Will it be flat, or can we even inch out small or modest growth in earnings?
Our view is that we may, on a calendar year basis, be able to inch out some positive gains. Just listening to the JSW Steel comments there, what's taking place in India is similar to what we're seeing in China as well. In other words, the global backdrop is quite weak, but for selected markets, given the boost from rural consumption, fiscal stimulus, they're actually seeing the potential for positive earnings coming through. And certainly China, India, and also Indonesia are three markets where we think we could actually see that this year. And that's a big change for us in terms of our views compared to just 8 weeks ago.
You've actually set out a target of 15,000 for the Sensex for the year. What is that based on in terms of earnings and valuations?
Overall, at target, 15,000 for the Sensex would represent about 3.2 times price to book. That compares to a long-term average, 10-year average of about 3 times price to book for India. So definitely not too demanding, especially given that we'll continue to see positive economic growth in India this year. Again, Indonesia, India, and China are one of only three countries, certainly in Asia, that will see positive growth in the year ahead. Overall, as I say, our view is that there is a high probability that we could inch out actual gains in earnings for the Sensex in calendar 2009. Certainly fiscal 2009 will definitely see positive earnings in our mind.
The other interesting point you've made in your report, Clive, is that you expect corrections to be shallower than your original forecast of about 15%. Is that purely because of money interest that you're seeing right now?
Yes. When we look at the trends in terms of capital flows since markets really turned around at the beginning of March, we can see markets, Taiwan, for example, about 2 billion in net inflows, India about 1.05 billion in net inflows. These markets have seen a big turnaround. It was January, February, there was continued red ink, we saw lots of outflows, but since March there's been a big turnaround. And that has contributed to our more positive view towards India. Previously we were neutral, being concerned about the twin deficit issue and the risk of a credit rating downgrade. Those issues still lurk in the background, but the key difference now is that foreigners are willing to commit money to this market.
Just keeping it with earnings, you've done some analysis as well on the ratio of upgrades to downgrades, and you've noticed that it's almost equal. Have you whittled that down to your India basket in terms of how many upgrades you've seen for your India universe coverage?
Well, the data on the earnings revision index is based on the consensus information from IBES. So it forms a very, very large group of earnings recommendations. For India, still downgrades exceed upgrades, but relative to in February, where the ratio was about 0.8, in other words, the majority of earnings changes were downgrades. We've seen that improve now to about 0.6, 0.65. We expect that trend to continue. Once we move over 0.5, that's the key inflection point. Basically, it means that we're seeing more upgrades coming through than downgrades. So for now, India is still remaining in negative territory, but the second derivative is improving. But as I say, selected markets in Asia, Taiwan, also Indonesia, that second derivative is now in positive territory.
And what kind of an earnings or EPS growth are you expecting for the Sensex in fiscal year 2010, Clive?
Fiscal 2010, as I say, it is possible. It is quite likely that we'll eke out some positive gains because calendar 2010 will definitely be positive. Calendar 2009, at the moment, our own in-house number is about minus 7%. But I do see some potential, or definite potential, for that number to be revised upwards. So overall, combining the two and looking at fiscal 2010, I think now that there's a realistic prospect that we could move into positive territory. Actual BNP data as of today still remains negative. But looking forward 6 months from now, I think there's a high probability that that number could actually move into positive territory. And that's the key catalyst, not just for our upgrade on India, but more broadly across the region. That fact that we see the move now into an earnings expansion phase of the market cycle. Past 6 months has been all about multiple expansion. But over the next 6 months, we see earnings expansion taking the market forward.
What's your tactical call, though, Clive? After the recent rally, most markets are up between 35 and 50% from their recent lows. Are you expecting a breather, or do you think the process of re-rating can actually extend without too much of a breather?
No, I think the gains that we've seen, particularly over the last week, in the likes of Taiwan, also India as well, I think that it is quite logical that we should see a pullback. It has been our view for a while. I should say that from a tactical point of view, we expected a correction, but on those downturns, it's been much, much shallower than what we expected. Overall, the catalyst for the correction in our mind was placements. We saw a significant increase, or we forecast a significant increase in placements in the second quarter, and we have seen many companies come to the market. But the pullback in the market on those placements has been a lot shallower than what we expected. And the main reason for that, from talking to clients over the past couple of weeks, has been that there remains a large pool of capital that has not increased its allocation to emerging markets. So what we're seeing that in terms of international flows, a lot of buying on dips. So I do expect a pullback in the market. Originally, we talked about a 15% for some markets, but I think now that's likely to be shallower because there is that mentality out there of buying on dips, particularly for those pension funds, international pension funds, that have not increased their allocation to emerging markets since the beginning of March.
Keeping that in mind, Clive, would you say 15,000 is your base case scenario for the market, or depending on earnings and higher interest in flows, it could actually be higher?
I would say it's our base case, but our base case is also that we do see continued foreign capital coming in. As I say, over the past 2 months, we've seen 1.05 billion flowing into India on net foreign flows. Obviously, we also expect that upgrade to earnings going forward. But I'd say our base case is for upgrade on earnings and for continued capital inflows, and hence our base case also would be that 15,000 for the Sensex is a realistic target at this point.
Clive McDonnell, good speaking with you. Great points from you. Appreciate you joining in today. That's BNP Paribas with their views on Asia, more importantly India, which they have upgraded.